Good morning, friends. Today I am talking about financial instruments. The financial instruments, this IND AS will cover three items. One is IND AS 32, and one is IND AS 109, another one is IND AS 107. IND AS 107 is disclosures part, IND AS 109 is a full financial instruments part, IND AS 32 is the definitions part. So IND AS 109, classification of the financial asset and financial liability. The measurement of the financial asset and financial liability, impairment and recognition, derecognition of the financial asset and financial liability, derivative hedge accounting. If you go to definition, India is 32, a classification versus liability versus equity and compounded financial instrument, offsetting financial asset and financial liability, and presentation of interest, dividend, losses and gains. Now we will go for topic 1, the financial instrument presentation. Meaning the financial instrument, it is a construct which gives rise to financial asset of one entity and financial liability or equity instrument of another entity. Just 1 minute wait, friends. Just wait 1 minute, friends. instruments. Now I'm talking about regarding India's financial instruments. In this India's financial instruments, we'll go by topic wise. The first topic one, the financial instrument in its presentation. Meaning, the financial instrument it is a construct which gives rise to a financial asset of one entity and financial liability or equity for instrument of another entity. Okay, the financial instrument is covered broadly three standards: India is 32, India is 109, India is 107. 1 minute, friends. Good morning, friends. I'm talking about India's 109 today broadly 3 hour session. See, this India is 109, India's combination of India is 32, India is 109, India is 107. India is 107 broadly speaks about disclosures. India is 32 speaks about definition and classification of equity versus liability, compounded financial instrument, and offsetting of the financial asset and financial liability, and the presentation and interest, dividend, losses, gains. This will speaks. Whereas India's 109 speaks like classification of the financial asset and liability and measurement of the financial asset and financial liability, impairment of the recognition of the derecognition of the financial asset and financial liability, and a derivative and hedge accounting. So these are the topics we are going to talk. First topic number one, the financial instrument presentation. See, the financial instrument, it is a contract which gives rise to a financial asset. If financial asset of one entity and financial liability are equal instrument of another entity. Okay, the financial instrument includes what? The primary instruments such as receivables, payables, and equity instruments, and a derivative financial instrument such as a financial options, futures, forwards, interest rate swaps, currency swaps. Financial asset, it includes cash, equity instrument of another entity, investment of equity shares, and contractual right to receivable, right to receive a cash. Contractual right to receive cash, another financial asset from another entity. Example, trade receivable. Example, example, trade receivables. A contractual right to receive cash or another. A financial asset from another entity, example trade receivables, investment in debentures, loan given to employees, bills receivable. All these we can call as a debt instruments, right? Whereas investment in equity shares, that's called equity instrument. There are three kind of instruments. What are those instruments? Equity instrument, debt instrument, financial instrument. So okay, these. Whereas your investment is a equity share is a equity instrument. Whereas contract right to receive a cash in another financial asset from another entity as a trade receivable, investment in debentures, loans given to employees, bills receivable, all these come under the debt instrument. Whereas financial instrument contractual right to exchange financial asset or financial liability with another entity under the condition that are potentially favorable to the entity. Example, derivative financial instrument. A contract that a contract that right to exchange financial asset financial liability with another entity under condition that are potentially favorable to the entity. Example, derivative financial instrument. A contract that will maybe settle in entity's own equity instrument and is a non-derivative for which the entity is maybe obligated to receive a variable number of entity own equity instrument, variable number of own equity instrument. Then also it is called as then it is called as a financial liability. Obligation is going to receive variable component of equity shares. Then for that purpose, that instrument is a financial liability instrument. Whereas options to convertible, even then financial liability. It is mandatory equity shares alone, then equity instrument. A contract that will maybe settle is in entity its own equity instrument and is a non-derivative for which the entity is or may be obligated to receive a variable number of entity own equity instrument. A derivative that will may be settled other than by way of exchange of a fixed amount of cash, another financial asset for a fixed number of entity own equity instruments. In such case, it is proved that it is a financial equity instrument. Equity instrument. Next. Now you understood what is meant by financial asset. The financial asset may be cash or equity instrument of another entity or contractual right to exchange financial asset or financial liability, a contract that will or may be settled in another may be settled in entity's own equity instrument. Entity's own equity instrument. One, a non-derivative for which the entity is or may be obligated to receive a variable number of entity own equity instrument, or a derivative that will or may be settled other than by exchange of the fixed amount of cash or another financial asset for a fixed number of entities own equity instrument. Okay. Now, financial liability, it includes a contractual obligation to deliver the cash, another financial asset to another entity, example trade payable, borrowing, and bills payable. contractual obligation to exchange the financial asset or financial liability with another entity under conditions that are potentially unfavorable to the entity. Example, derivative financial instrument. Derivative financial instrument. Okay. A contract that will maybe settle in entity own equity instrument and is a non-derivative for which the entity is maybe obligated to deliver a variable number of entities one equity instrument, or a derivative that will maybe settled other than by the exchange of the fixed amount of cash or another financial asset, or fixed number of the entity one equity instrument. So this is the definition of the financial liability definition. Now, 1 minute, friends. A contract that will be settled by an entity its own equity instrument. It is a non-derivative or derivative. A non-derivative for which the entity is may be obligated to deliver the variable number of entity one equity instrument is a financial liability. A deliver that will may be settled other than by the exchange of the fixed amount of the cash or another financial asset for fixed number of entity at its own equity instrument. Now, what is meant by equity instrument? It means any contract that entitled to residual interest in the asset of the entity after deducting its liabilities. Okay. Examples of equity instrument include non-portable ordinary shares or equity shares issued by companies. Some portable instruments, if they meet requisite criteria and are not classified as a financial liability. Some types of the preference shares where repayment and distribution is at the discretion of the issuer. Warrants are written call options that allow the holder to subscribe for a purchase a fixed number of non-portable ordinary shares in the issuing entity in exchange for a fixed amount of cash or another financial asset. Understood, friend? So these are examples. For example, non-portable ordinary shares or equity shares issued by a company. Example of the equity instrument. Some portable instrument, if they are meet the requisite criteria and are not classified as a financial liability, where the liability which you are not able to classify as a financial liability, then it is an equity instrument only. Okay. 1 minute, please. So now, equity instrument, it means any contract that entire the residual interest in the asset of the entity after deducting all liabilities is called equity instrument. Okay. Now, for example, we'll classify few items: cash, financial asset; cash equivalent, financial asset; bank balance, financial asset; deposits given, financial asset; deposits received, financial liability; trade and trade receivable, financial asset; trade payable, financial liability; bills receivable, financial asset; bills payable, financial liability; investment in equity shares, financial asset; instruments in equity shares is a financial asset; investment in debentures, financial asset; promissory notes are receivables to receive government bond, financial asset; promissory notes payable in government and bonds, financial liability; perpetual debt instrument, financial asset; prepaid expenses, not a financial asset; inventory, not a financial asset. Well, inventory is not a financial asset. Okay. Property, plant and equipment, not a financial asset. Intangible assets, not a financial asset. Advance received for goods and services, not a financial liability. Deferred revenue, not a financial liability. GST payable, not a financial liability. Financial guarantee is a financial liability. A right to use asset, not a financial asset. Mandatory redeemable preference shares, financial liability. Gold, not a financial asset. Global bonds held, gold bonds held, financial asset. These are the, just 1 minute, water. Just 1 minute, friends. Water. See, friends, next. See, the topic one, Manikanta, ఇండియాస్ 109 ఫైనాన్షియల్ ఇన్స్ట్రుమెంట్స్ ఎక్స్ప్లెయిన్ చేస్తున్నా, జాయిన్ అవుతావా? లైవ్ 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 లో స్టూడెంట్స్ కి చెప్తున్నా, కొంతమందికి ఉన్నారు, ఇద్దరు ముగ్గురు ఉన్నారు. నువ్వు వచ్చి జాయిన్ అవుతావా? జాయిన్ అవ్వు, బాగుంటది. జస్ట్ నువ్వు ఏమైంది, లైవ్ షేర్ చేసేదా? వీడియో షేర్ చేస్తాను, యూట్యూబ్ చేసానా? ఆ, చెయ్యి. ఇది నువ్వు జాయిన్ అవ్వు, నీ డౌట్స్ కూడా నువ్వు అడగవచ్చు లైవ్ లో, లేదంటే జూమ్ మీటింగ్ పెట్టమన్నా పెడతా. ఆహా, ఓకే. సరే సరే సరే. ఓకే ఓకే ఓకే, జాయిన్ జాయిన్. ఓకే. See, friends, we talked about the topic number one. That's called the presentation of the financial. We talked about the financial asset, financial liability, equity instrument, debt instrument, financial instrument. These three we talked in the first session. Now the topic starts compound financial instrument. The topic two is compound financial instrument. The meaning of the compound financial instrument: the compound financial instrument contain elements of both financial liability and equity instrument in a single contract. As per IND AS 32, the fair value of the compound financial instrument proceeds received should be split into the financial liability and equity instrument element on initial recognition. Understand? Not understand. Yes, tell me. The compound financial instrument contain elements, financial liability and equity instrument in a single contract. As per IND AS 32, the fair value of the compound financial instrument proceeds received should be split into the financial liability and equity instrument element and initial recognition. Okay. Okay. For example, we'll take some examples to recognize whether it is a financial liability or compound financial instrument. Will be solve few sums. Then you'll understand. The financial instrument redeemable preference shares with fixed dividend per annum. You tell me, it is a compound instrument or financial liability? A redeemable preference share with fixed dividend per annum. Tell me, friends, what? Huh? Okay, I'll tell. The redeemable preference shares with fixed dividend per annum is a financial liability. Okay. Now, non-redeemable preference shares with a cumulative non-cumulative dividend at the discretion of the issuer is equity instrument. Is equity instrument. Redeemable preference share with a cumulative or non-cumulative dividend at the discretion of the issuer. Redeemable preference share with a cumulative or non-cumulative dividend at the discretion of the issuer is called a compound financial instrument. It is a combination of financial liability and equity instrument in a single contract. That is the reason it's called as compound financial instrument. Okay. Now, non-redeemable preference shares, non-redeemable preference shares with a cumulative dividend uh, payable only on the liquidation, and there is no contractual obligation to exist to pay unless upon the liquidation. This is called what instrument? Equity instrument. Okay. Because liquidation and all will not happen right now, no. It will happen last, no. So the immediate redemption or immediate liability is not coming. It's coming at the end of the contract, not a contract. At the end of the closure of the company while in liquidation. Such an option could be not called as a financial liability. It is called as an equity instrument. Okay. Now, redeemable preference share with a cumulative dividend payable only on liquidation, and there is no contractual obligation to exist to pay unless upon the liquidation. This is a compound finance instrument. Previously, what we talked, non-redeemable preference share with a cumulative dividend payable only on liquidation, and there is no contractual obligation exists to pay unless upon the liquidation. Such an instrument is equity instrument, whereas redeemable preference share with a cumulative dividend payable only on liquidation, and there is no contractual obligation exists to pay unless upon the liquidation. What here? Here case is redeemable, previous case is non-redeemable. Since non-redeemable, even though it is liquidation, we called as equity instrument. Even though redeemable, even though it is the contractual obligation will arise on the date of liquidation, even then, since it is redeemable, I am recognizing as a compound financial instrument in my balance sheet. Understood, friends? Now, a redeemable preference share with a cumulative dividend, and there is a contractual obligation exists to pay dividend, that entity doesn't have an unconditional right to defer the payment. Understood? Redeemable preference shares with cumulative dividend, and there is a contractual obligation exists to pay dividend. That entity doesn't have an unconditional right, an unconditional right to defer the payment. This case, it is a financial liability. Redeemable preference share, the cumulative dividend, and there is a contractual obligation exists to pay dividend. That entity that entity doesn't have an unconditional right, an unconditional right to defer the payment, unconditional right to defer the payment, not have any unconditional right to defer the payment. That is the reason what happened. It considered as a financial liability because contractual obligation exists. That too, these are the redeemable, and that doesn't have that doesn't the entity doesn't have unconditional right to defer the payment. These are the reasons we consider as a financial liability. Compulsory convertible preference shares with a discretionary dividend is equity instrument. Compulsory convertible preference shares with fixed dividend is compound financial instrument. Compulsory convertible preference shares with fixed dividend is a compoundable financial instrument. Redeemable debentures, redeemable debentures with fixed interest, financial liability. Because the contractual obligation exists to pay. Understand, friends? Next. Irredeemable debentures with fixed interest is a compoundable financial instrument. Irredeemable debentures, irredeemable debentures with no guarantee of interest is equity instrument. Optionally, a convertible redeemable debentures is there is a contractual obligation, equity instrument, and financial liability exist. That is the reason we could call it as a compoundable financial instrument. Okay, redeemable debentures with discretionary interest is a compoundable financial instrument. Irredeemable debentures with no guarantee of interest is equity instrument. Optionally convertible redeemable debentures is called as compound financial instrument. Participating redeemable preference shares with fixed dividend. Redeemable preference shares with fixed dividend is a compoundable financial instrument. How to split a compoundable financial instrument? The fair value of the fair value of the fair value of the compoundable financial instrument proceeds received minus the fair value of the liability component, the present value of the contractual cash flows outflows discounted at market rate of interest of a similar instrument without equity component. If you deducted that, you will receive the fair value of equity component. Understood, friends? Tomorrow on one more video, I'll come back. Today, this much only I'm discussing on IND AS 11109. Tomorrow, the remaining portion like early settlement and amendment of the terms of the convertible instrument to induce early conversion. These and all we'll talk tomorrow. Bye bye. See you. Tata.